privileges. After World War II, American industry powered an era of extraordinary economic growth.
Banks mainly financed factories, trade, and the expanding American middle class.
The Bretton Woods system placed the dollar at the center of global finance. For decades, economic growth depended primarily on production and manufacturing. In this era, finance largely served the needs of the real economy.
American factories expanded rapidly as industrial production fueled post-war prosperity.
A growing middle class increased demand for homes, cars, and consumer goods. Banks played a supporting role by financing production and household consumption.
Financial markets existed, but they remained smaller than the industrial economy.
During this era, finance served the needs of industry rather than dominating it. The Bretton Woods system placed the US dollar at the center of global finance. American economic strength anchored the stability of the international monetary system.
Manufacturing remained the primary driver of American economic growth.
In 1971, the Bretton Woods system finally collapsed. The collapse of fixed exchange rates transformed global financial markets. During the 1970s, inflation began destabilizing the American economy.
The oil crisis sent energy prices soaring and intensified economic uncertainty.
Central bankers struggled to control inflation and restore economic stability. Policymakers began reconsidering how financial markets should be regulated.
New reforms gradually opened financial markets to greater competition. In the 1980s, financial deregulation began reshaping American markets.
Investment banks expanded rapidly as capital markets grew in influence.
New financial instruments began transforming the structure of global markets. Corporate mergers and leveraged buyouts became defining features of the decade.
The financial sector was becoming increasingly central to the American economy.
Derivatives markets expanded rapidly, allowing investors to trade financial risk.
Advances in computing began transforming the speed of financial trading. Global investors increasingly moved capital through American financial markets.
Companies increasingly focused on maximizing shareholder value and stock performance. And
Wall Street emerged as the dominant hub of global financial activity.
Financial markets were becoming the central engine of modern economic activity.
Large investment funds began managing trillions of dollars in global assets.
Financial markets were becoming the central engine of modern economic activity.
Consumer borrowing increased as credit became easier to access.
Financial assets were beginning to shape economic expectations across society. The rapid rise of technology companies fueled a powerful stock market boom.
Investors poured money into internet companies with little proven revenue.
When the bubble burst,
Billions in market value disappeared almost overnight.
The Federal Reserve lowered interest rates to stabilize economic growth.
Cheap credit began fueling a massive expansion in the housing market.
Mortgage lending expanded rapidly as home prices continued to rise.
Banks packaged mortgage loans into complex financial securities.
These securities spread housing market risk throughout the global system.
Financial institutions increased leverage to maximize profits from rising markets.
By the mid-2000s, the American housing bubble had reached dangerous levels. By 2007, mortgage defaults began rising across the housing market.
The value of mortgage securities began collapsing inside global financial markets.
Major banks suddenly faced enormous losses tied to housing debt. In September 2008, Lehman Brothers filed for bankruptcy.
The crisis rapidly spread through banks, markets, and economies worldwide.
Central banks intervened quickly to prevent the collapse of the financial system. The Federal Reserve rapidly reduced interest rates to restore market stability.
Central banks injected massive liquidity into global financial markets.
Governments provided emergency support to stabilize major financial institutions.
These interventions helped stabilize markets after the financial crisis.
Financial markets slowly recovered as liquidity returned to the global system. Unprecedented monetary policies supported financial markets for more than a decade. Corporations issued large amounts of debt during years of low interest rates. Rising asset prices reshaped wealth and investment across the global economy. Finance had become deeply embedded in the structure of modern economic life. Rising asset prices reshaped wealth and investment across the global economy. Finance had become deeply embedded in the structure of modern economic life.
Wall Street institutions managed vast pools of global investment capital.
The US dollar remains the central currency of global financial markets. Finance now plays a central role in shaping the modern global economy. Financial markets now influence decisions made across the entire global economy.
Capital moves rapidly through financial networks connecting economies worldwide.
Economists continue debating the long-term impact of financialization.
The challenge is balancing financial innovation with long-term economic stability.
The correlation broke. We're bleeding billions!
We need more capital now. The banks are pulling their lines.
Sell everything. Get out of the Deutsche Mark positions.
Financial markets now influence decisions made across the entire global economy. Capital moves rapidly through financial networks connecting economies worldwide.
Economists continue debating the long-term impact of financialization. The challenge is balancing financial innovation with long-term economic stability.
The rise of financialization has profoundly reshaped the structure of the modern world economy.